First, the tariffs came. Then the invitation. The US just hit China with tariffs up to 245%, crippling prices on EV batteries, solar panels, and telecom gear overnight. But while the punch was still landing, Washington extended a handshake, urging Beijing to sit down at the table. So, is this war or negotiation theater? Why would a country throw a diabolical punch and then ask for peace in the same breath? Is this brinkmanship or desperation? On April 14, 2025, the Trump administration raised tariffs on nearly $150 billion worth of Chinese imports, bringing levies on key categories like EV batteries, telecom equipment, and solar panels to a record 245%, according to the USTR's public briefing. Simultaneously, Trump's top trade envoy publicly stated that Washington remains open to serious negotiations with Beijing, creating what Bloomberg's David Fickling called a diplomatic paradox masquerading as strategy. If tariffs are punishment, why accompany them with invitations to talk? One theory, voiced by former IMF economist Eswar Prasad, suggests Washington believes pressure alone can extract a concession. But China's non-response suggests a miscalculation. Escalation may not be leverage, but proof the US has exhausted its options. And while markets initially rallied on the negotiation headline, the tariff details tanked key import-heavy indices, signaling that investors aren't buying the idea of simultaneous pressure and peace. So the real question is, if this is a strategy, who's it working on? California, home to $166 billion in annual Chinese imports and 11% of U.S. GDP, is becoming the first battleground state in an economic civil war. After the 245% tariffs were announced, Lieutenant Governor Eleni Kounalakis blasted the White House for destroying supply chains and feeding inflation, and a coalition of 47 business groups from Silicon Valley to Long Beach petitioned the federal government for exemptions by April 17th. According to a Morgan Stanley regional impact study, California stands to lose over 142,000 jobs if the tariffs hold through Q3, mostly in tech manufacturing, logistics, and retail. Even red states like Texas, which export oilfield equipment and agricultural goods to China, are quietly raising concerns. But politically, the fallout is most visible in California, where bipartisan lawmakers are framing the tariffs not as a trade issue, but as a direct assault on state economic sovereignty. If Trump's plan was to isolate China, he may now be isolating himself at home. The Federal Reserve now faces what Bank of America's Michael Hartnett dubbed a stagflationary endgame. As of April 2025, U.S. inflation has ticked back up to 6.2% year over year, fueled by tariff-driven price hikes on imports from China, according to Bureau of Labor Statistics data. Meanwhile, GDP growth in Q1 slowed to 1.1%, down from 2.8% the previous quarter. Rate hikes to combat inflation risk, tipping the economy into recession, yet cutting rates could further erode confidence in the dollar, which has already weakened 4.6% against a trade-weighted basket since February. According to a March note from JP Morgan, central banks in India, Brazil, and Saudi Arabia have reduced their U.S. Treasury holdings by a combined $43.7 billion in just 6 weeks. The Fed isn't just walking a tightrope, it's watching the rope fray from both ends. And unlike 2008, there's no coordinated global response coming. So if Powell tightens, he may break growth. If he eases, he may break the currency. What happens if both snap? On April 15th, China's Ministry of Foreign Affairs issued a brief statement. No negotiations under pressure. No elaboration. No press conference. According to Tsinghua University scholar Shen Yi, this silence was not passive but tactical. China is signaling that it will no longer play inside America's narrative arc. Rather than responding to Washington's dual-pronged approach of tariffs and outreach, Beijing has opted for disengagement, denying the U.S. the ability to claim diplomatic progress. A Financial Times analysis noted that China's Politburo sees talks now as validation of erratic U.S. policymaking, and prefers to bide time while shifting global trade links elsewhere. Meanwhile, Chinese social media, monitored by the South China Morning Post, has erupted in nationalist support for the government's refusal to engage, with state influencers calling negotiation a form of surrender. In refusing to talk, Beijing may be leveraging something Washington underestimated: indifference as power. On April 16th, Beijing imposed a 125% retaliatory tariff on U.S.-made aircraft, semiconductors, and construction equipment, effectively nullifying nearly $17 billion in expected 2025 exports, according to the U.S. Department of Commerce. Boeing, the biggest casualty, saw its stock plunge 11.8% in a single day after China's Civil Aviation Authority ordered state airlines to cancel all pending Boeing orders, totaling over 70 aircraft, worth an estimated $10.6 billion. Airbus, meanwhile, signed a new strategic supply deal with Beijing the same week, signaling not just retaliation, but replacement. Speaking to CNBC, Eurasia Group's Kevin Rudd described the move as less about pain and more about a paradigm shift. China's not retaliating anymore. It's bypassing. The tariff wasn't a mirror, it was a message. China no longer sees value in economic interdependence with the US. And if Boeing was the first target, it's likely not the last. So what happens when the world's second largest economy stops playing by your trade book? On April 17th, 2025, the yuan closed at 7.98 per US dollar, the weakest level since late 2023. That wasn't a currency collapse, it was a calculated move. According to Bloomberg's chief Asia economist David Q, the People's Bank of China deliberately set its daily reference rate 84 basis points weaker than market expectations, triggering a surge in export orders from Europe and Southeast Asia within 48 hours. The immediate impact? A 3.2% jump in Chinese manufacturing orders logged via customs data, even as U.S. tariffs climbed. More critically, it undercut Washington's 245% tariffs by rendering Chinese goods 8 to 12% cheaper in dollar terms, essentially neutralizing much of the intended price pain. In short, the devaluation acted not just as a pressure valve, it flipped the board, turning tariff penalties into global discounts. But that currency move also sent a deeper message. Beijing isn't negotiating on Washington's timeline, it's rewriting the terms entirely. The trade lanes are already diverging. China's exports to the U.S. dropped 27.4% year-over-year in the first quarter of 2025, while shipments to ASEAN surged 19.8%, and EU-bound goods rose 13.2%, according to China's General Administration of Customs. These aren't fluctuations, they're realignments. Chinese officials finalized a 25-year bilateral trade pact with the EU in early April, streamlining green tech exports via high-speed rail corridors and bypassing U.S. seaports entirely. The agreement includes provisions for RMB-denominated contracts and introduces a fast-track dispute resolution mechanism outside of the WTO, signaling an institutional shift as well. Meanwhile, Huawei, CATL, and BYD have expanded operations in Indonesia, Hungary, and Poland, cutting dependency on U.S. clients and jurisdictions. Economist Alicia Garcia Herrero of Natixis calls it functional decoupling, where trade doesn't collapse, it reconfigures geographically and financially. And that shift isn't speculative. It's printed in customs invoices, signed in bilateral contracts, and visible on shipping routes that now avoid Long Beach and New York altogether. China's $273.4 billion first quarter 2025 trade surplus, confirmed by SAFE, State Administration of Foreign Exchange, isn't sitting in reserves, it's being redeployed with strategic precision. Unlike Western central banks dependent on monetary easing, China is leveraging surplus cash to directly fund industrial expansion. The Ministry of Finance allocated 450 billion yuan, $62.1 billion, into its third-phase semiconductor fund, according to a Reuters report, while earmarking 310 billion yuan, $42.8 billion, for consumer EV subsidies targeting Tier 3 and rural markets. Additionally, Beijing has funded 14 new RMB clearing banks across Eurasia and Africa, stretching from Nairobi to Frankfurt, to expand international yuan adoption without issuing new debt. Columbia University's Sheng Liu argues this model sidesteps inflation while preserving monetary independence. It's fiscal precision powered by trade, not by central bank balance sheets. In effect, China is underwriting its economic growth using surplus, not stimulus, offering a blueprint that's difficult for indebted Western economies to replicate. The fracture is becoming measurable. As of April 2025, 61 countries conduct more than 15% of their trade in non-dollar currencies, double the level from 2022, according to IMF data reviewed by the Financial Times. The yuan's share in global SWIFT transactions rose to 5.4% in March, the highest ever, while the dollars dipped below 39% for the first time since 2013. On the ground, Brazil now settles nearly all oil imports from Angola and Russia in yuan. Meanwhile, India is pushing for rupee-ruble and rupee-dirham settlement corridors. U.S. allies like South Korea and Germany remain dollar-aligned, but are hedging by increasing exposure to RMB-denominated bonds. A World Bank analysis published April 10th states the global economy is entering a bifurcated financial order, where competing trade blocs no longer mirror political alliances, but currency zones and capital flows. The U.S. still leads in financial power, but China's playbook doesn't seek dominance. It seeks insulation, and the faster that strategy matures, the harder it becomes for the world to reverse. If China just flipped the rules, redirecting exports, weaponizing its currency, and mobilizing cash reserves without firing a single shot, what happens when the U.S. runs out of leverage? Not in theory, in practice. Because tariffs are capped, debt ceilings are real, and the dollar's dominance, once unquestionable, now comes with caveats. So the real question isn't whether we're in a trade war. It's whether this is the last one the U.S. gets to lead. And if this is how China plays defense, what does its offense look like? Stick around because the next move could redraw not just supply chains, but the entire global map. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.